Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. The chips are down for Asian equities after a sell-off on Wall Street, driven by Nvidia's underwhelming results. Sentiment being further sapped by Trump's latest comments on tariffs. The US president says 25% levies on Canada and Mexico will take effect on March 4th, with an additional 10% being imposed on Chinese imports. The tariff risk also clouding the outlook for India's recovery as we await latest GDP growth data. Officials there already looking to lower tariffs on imports, including cars, to evade Trump's threatened reciprocal levies. And this video of a humanoid Chinese-made robot executing flawless kung fu moves, helping spark a rally in robotic stocks. Goldman Sachs will be joining us to debate whether this is the sector to watch in China. Well, the chips are down. Semiconductor stocks are leading losses in the region as traders brace for Trump tariffs, and Nvidia continues to drag sentiment. Avril Hong is here with more. Avril, it's really either this is a breather or, you know what, perhaps the start of a trend.
I think it's a more worrying picture that we're seeing given the extent of the losses we're seeing on the region's benchmark today. And indeed, it's headed for its first weekly loss in 7 by the most since December. It's been really quite a week for Asian stocks, and today you're seeing the chip stocks dragging the Japanese, South Korean benchmarks. Maybe Taiwan being shut is also amplifying some of the pain. Tech, another pain point for the Hang Seng. It's been really a week of tariff confusion, and now Trump saying levies are a go come March 4th is forcing traders to price that in once again. Now, flip the board. I wanted to highlight what we're seeing on the Asia chip gauge of Bloomberg because it's fallen every day of this week. And note here, this, of course, is a gauge which includes in the basket TSMC, SK Hynix, Samsung Electronics, Tokyo Electron, and it's actually at the lowest level since the start of the year. So that also kind of tells you that it might be more than just about Nvidia underwhelming on results. Flip the board again, because as those tariff threats came in, we saw the dollar bouncing back. That left the offshore renminbi with its worst session since December. I think it's firming up a little bit today, but keep in mind that the PBOC has sort of been this anchor, right, for the yuan fix. It's kept it at 717 thereabouts for all of this month. Not just that, since Trump's inauguration, indeed. So it's really, you can see here about yuan stability, even in the face of Trump challenges, especially as we look ahead to the 2 sessions next week. Has.
Errol, thank you so much for that. We have breaking news just to mark what's happening in Thailand. The Thailand stock benchmark falling 20% from that October high. Of course, this market has been under a lot of pressure. We saw how the Bank of Thailand cut its rates just this week to try and prop up sentiment, not just in the economy, but also that market. But of course, we can see from the movement today that the cut that we saw this week isn't doing much to prop up sentiment. Again, the SET falling 20% from its October high, on track for a bear market. This is the story we're seeing pretty much across emerging markets. Funds pretty much gravitating towards the US, and with the USD in focus and mighty dollar putting a lot of pressure on Asian markets as well as Asian currencies. The benchmark in Thailand set for a bear market. Now let's get perspective from Sunil Garg, Group CIO of global investment firm Lighthouse Canton, which manages over $4 billion in assets. Sunil, first off, we saw how the Thai stocks are getting a lot of pressure today, down 20% from the highs. I mean, this is the story that we're likely to see generally for emerging markets, given the strength in the US markets.
Yeah, I mean, look, emerging markets have been underperforming the US now for about 14 years, right? So we've got to put that into context. And I think really the main emerging markets, at least in Asia, that have mattered in some form, shape, or the other are China and India. And it's been India that was performing up until maybe 6 months ago. And I think it's China that looks more attractive. And so it's not just the US we've got to think, in context, but we've also got to look at China as the destination, which then has obviously an impact on some of the other Asian markets.
Interesting that you brought up China, of course, China tech in particular having its best quarter in about 10 years versus their US peers. How are you reading this, I guess some say decoupling?
Yeah, I mean, look, you've got to just, forget the DeepSeek moment for a moment. And I think look at, the Chinese economy cyclically is or has been at a low point. And in that sense, there is a lot of headroom for recovery as compared to where I think some of the more developed world economies have been, you could argue, are in the tooth on their economic cycle. So from that perspective, I think China has very good reasons to decouple. And of course, on the technology sector, with all the sanctions and tariffs being imposed, it's probably leading to a faster development in China. So I think China's got a lot of positives going for it right now.
But there are a lot of non-believers out there. We have the likes of Carson Block who say that China remains uninvestable. He has issues with regulation, the regulatory environment in the country in particular. What would you say to them?
Yeah, absolutely. That's been true yesterday. That was true 6 months ago. And that's probably going to be true for the next few months as well, right? So I think take that as a constant. The question is, are you getting improvements at the margin? And I think you are. And I think that's really what I'm looking at. So none of the structural issues highlighted for China are new, but that's in the price. So I do think that, and I think this is really what's actually attractive, that positioning in China is very low because there are still plenty of non-believers out there. And I think that's really when the opportunity arises.
You talk about the price. When you take a look at the S&P and the NASDAQ, month to date, they're down 3-4%. What's in that price?
Yeah, I think there is still, I would say, a fair bit of optimism baked in. I think we have probably more downside. And I think if you look at the composition of the market, it's technology that's actually underperforming, and it's the discretionary that's underperforming. I think what is attractive is if you look at the defensive sectors, whether it's healthcare or staples, they are the ones that look attractive. So I think this is a market which is still living on a growth story, but you probably have growth concerns coming in. And I think so therefore, I don't think you've got growth concerns in the price yet.
So what does it mean? What do you do with your Max 7? A lot of that growth story is being played out in the tech sector, in the Max 7 in particular. Do you keep buying them? Do you buy the dip? Or do you then gravitate towards, the tech plays in China instead?
I've stopped thinking about Max 7 as a single construct any longer, because I think within the Max 7, I would say, what is kind of more aligned with AI and Gen AI are probably 3 or 4 stocks. The likes of Apple and Tesla are consumer companies. And so I like to think of the AI ecosystem. And I think there's a lot more to the AI ecosystem than just chips and semiconductors. And I think that's the part that we still like. But the Max 7 on its own, I think, has a number of companies. Tesla is a great case in point where somehow the market assumed that the association of the CEO with the president is going to make more car sales. Now we know that's clearly not happening. So I think the Max 7 on its own is probably lost meaning a little bit as a construct.
So look at it as an AI ecosystem, and on the back of that, NVIDIA looking still attractive, given that demand is likely to stay strong. So that 8.5% slump that we saw in NVIDIA is a buying opportunity.
I do think so. It's going to be volatile. Obviously, the bar is very high. The markets, become used to a beat and a beat. And they're still guiding for a 9% quarter-on-quarter top-line growth, which is pretty phenomenal. Yes, I think there is a longer-term impact on margins, but I don't think you will see air pockets on the likes of NVIDIA, that you're not going to see just a gap down on their top line or bottom line. So in that sense, yeah, I think you do get these buying opportunities in the likes of NVIDIA. But, when I talk about the ecosystem, I think there is a lot more than, I think, obviously, NVIDIA attracts the most attention. But I do think there are other opportunities within that. But yes, I think NVIDIA does look attractive.
And Tesla's weakness will persist from here?
Well, Tesla's biggest problem has been and still continues to be that they're just not selling enough cars. I mean, that's not just in China. We saw the European data come out recently. And I think there was, if you go back maybe 6, 7 months ago, there was quite a fading of interest from the consumers on electric vehicles in general. And, you've seen automakers move to the hybrids quite a bit, almost with a vengeance. And so I think you've got a much more fundamental operational issue with Tesla as you get to car sales picking up. I think that's that's what would drive Tesla. And of course, the noise around the CEO of the company doesn't help at the moment.
What is the biggest risk for the Max 7 at this point in time? Is it overvaluation? Is it the possibility of that trade war, the chip war between the US and China?
Yeah, I would say valuations are expensive, and I honestly care less about those as long as you've got earnings growth, right? But I think in general, I think tariffs and trade war and retaliation is clearly a risk. I do think there is a remnant risk in inflation. Now, I'm not a stagflation believer, but I do think that any adverse data points on inflation, and you've got PCE coming out later today, I think that definitely has a much larger impact on whether it's the Mag 7 or technology in general.
Sunil, so far, the rally that we've seen in Chinese stocks is pretty much driven by the Chinese themselves, those mainland Chinese investors buying into Chinese stocks in Hong Kong. I'm just wondering, when do you see international investors, foreign investors, buying into this rally?
Yeah, I think we've already started to see a little bit of FOMO creeping in. Over the last kind of week, 10 days, I've seen a number of sell-side reports coming out talking about that, China's gone from underweight to neutral to some people going overweight. So as you mentioned earlier, there is plenty of non-believers out there. So I think the marginal money will flow. And the fact that US tech has been struggling, I think that probably helps the case for China tech as well. And I think the important point about the rally being driven by domestic money is actually very powerful, because in that sense, it doesn't become a hostage to global capital flow. So there is, I think, plenty of momentum, plenty of levers from here as well.
Can they get to the heyday, the kind of gains that we saw before?
Well, I mean, look, there's a lot of these companies are very different. Okay, let's just take the case of Alibaba. This company, when it used to trade in the 300s, was a very different company. Today, it's a lot more like Amazon in terms of much more of a technology company than an e-commerce company. And so from that perspective, yeah, could we go back to the heyday? Yeah, could we go higher? Possibly, because I think the fundamental nature of a lot of these businesses is very different from what we remember from when the heyday was a few years ago.
Sunil, hang tight. Sunil Garg, Lighthouse, Canton, is sticking around. Still coming inside, a poll shows that Trump's tariffs are going to raise inflation. We discuss what that means for the Fed and whether investors should be worried. We have details in just a moment. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. President Trump is standing firm on his tariff agenda, but American consumers are getting worried. According to a Harris poll conducted for Bloomberg News, almost 60% of U.S. adults expect Trump tariffs, if enacted, will lead to even higher prices. Some 44% say the levies are likely to be bad for the U.S. economy, compared with 31% who expect a boost. Speaking with reporters, Trump downplayed concerns his flurry of tariffs would drive up American prices.
It's a myth that's put out there by foreign countries that really don't like paying tariffs, and especially to even up. So we've been treated badly by a lot. We're using tariffs. And I find, and you just have to look at the numbers, but I find that it's not about inflation. It's about fairness. And the inflation for us has not existed. And I don't think it's going to exist.
Trump's tariff orders include a provision that suspends the de minimis trade rule for shipments that originate from China, Canada, or Mexico. The rule allowed consumers to ship in packages worth less than $800 into the U.S. duty-free. We asked Amazon CEO Andy Jassy how change in the rules are impacting the online retail giant's business.
On de minimis specifically, we have a certain number of items that are shipped in that way as well for things like haul, which is our new low price offering. We maybe have less of it than some other companies like the ones that you mentioned. But I think it's early in this administration, but what I would say is that it is encouraging to us that we have an administration that wants to hear from business. I would say that we've been a business through 6 administrations. Every single one of them, our primary focus is to take care of customers, but we try to build a productive relationship with the administration because we want to help the country. And I would say that some administrations are more receptive to it than others, but this administration cares about what business thinks. And I've always been surprised that it isn't obvious that the best economic results for a country are going to be when the public and the private sector collaborate. And, I don't expect the government to kowtow to what companies want, but they should get their feedback and their input because they're going to make policies better together if they collaborate. And I'm encouraged early on that this administration wants to talk to businesses.
Are you taking calls personally?
I take calls. We talked, same thing with all the administrations. We talk to people in the administration. We share what's working for us, what's not working for us, concerns that we have. As I said, some administrations care more about our feedback than others.
Has Trump cared about yours? Have you spoken to the President?
I have spoken to the President. Look, as I said, this administration has been pretty busy the first month. But I am encouraged that they are having conversations with businesses and they do care about our feedback. And we'll see what happens, but it starts with a dialogue. You have to have a dialogue to have any kind of relationship.
Amazon CEO Andy Jassy with Bloomberg Technology co-anchor Caroline Hyde. Now, Sunil Garg is still with us, Group CIO of Lighthouse Canton. Sunil, your thoughts on Trump's tariffs, inflationary or not? I mean, if you speak to some people in his camp, they say, you know what, even though you may have inflation trend higher, the stronger dollar is going to help.
Yeah, I mean, I think Trump thinks tariffs are a beautiful thing, as he calls them. I do think they are inflationary, and I think there's an associated aspect about immigration which doesn't receive as much attention. You have to look at the experience of Great Britain post-Brexit, and I think labor shortages also, don't help. So, yeah, I think his policies definitely have an inflationary hue to it.
How much of that is being priced in by the market?
Not a lot, I think. I think the problem is that there is no certainty on what he's going to do on the tariffs because, on one hand, it's quite clear he's using them as a bargaining chip, but he kind of whips it out of his back pocket whenever it's convenient. And so in that sense, that uncertainty and that volatility is just, prevalent at all times. And so I think the problem here is that there is no clarity that you're going to have tariffs and let's move on. Because, you look at the elevator tariffs in China, there's a tariff and then there's a 10%, then there's another 10%. And so in that sense, I think that's what's, a big negative in general. And I don't think that particular thing is priced in.
So you got to wonder how the Fed is viewing it, how it's assessing it, and what the Fed's path might look like from here. So we're expecting, or markets expecting, perhaps one more rate cut this year. But the thing is, it could be a rate hike.
I'm still not in the rate hike camp, but I have to say that Mr. Powell's job is trickier than ever before because you do have an economy that is slowing at the margin. And I think insular approaches, which the administration's taking, probably make it slow faster. And at the same time, you've got an inflation issue. So I think they're on an extended pause. Yes, I think the market's expectations of a cut have just been pushed back. And, at the moment, it's like, OK, we'll see when we get there. If the economy slows down materially, then I think they might think about cutting. But right now, it's just an extended pause. And it's a very tricky position.
What is an extended pause, though? Sunil, how long is that pause likely to be?
I mean, look, nothing until fall, and you may not even get a rate cut this year. Look, to me, the more important thing is the labor market going to crack, which is going to drive down consumption? Is that something that's what ultimately is going to get the Fed to act? Tariffs, I think, will have a little bit of a slow burn effect. It's not an instantaneous impact. Yes, there will be some, but I think for the next 6 months plus, I think there's probably no Fed action one way or the other.
So what kind of correction can be anticipated, given that this market is poised for a Goldilocks situation, priced for perfection right now? What kind of movements are you anticipating? What kind of correction? And where do you hide?
Well, the last question first. I think you hide in the likes of healthcare. I think they've been beaten down a lot. There is earnings growth out of healthcare, and I think the healthcare sector is actually doing really well, especially the big pharma, which has been a massive underperformer. So I think healthcare and staples do look attractive. I think treasuries have started to look attractive, right? Treasuries have corrected massively. So I'm not talking corporate bonds, but treasuries are attractive as well. So in terms of the equity correction, I think, you look at the headline, and I think that's the interesting thing about the S&P is that there's so much divergent moves going on within that. I think 5,700 is within the realm of possibility in the short term. Could there be deeper corrections? Yes. But I'm looking at opportunities under the hood. And I think healthcare, staples, treasuries, I think those are looking attractive right now.
And speaking of correction, we're seeing that correction in India as well. Are you a believer that there will be a recovery in the Indian market story?
There's always a recovery. The question is when, right? We've been not overly positive in India cyclically for quite some time now. The long-term structural story is still intact, right? I think that's great. Right now, the problem is, I think GDP is missing estimates. You've got earnings growth for the current financial year, which is kind of very, muted, like low single digits. And until you see that recovery to justify the valuations, I mean, there isn't a huge catalyst at the moment for India. We keep looking for that, haven't found it yet. So there will be a recovery at some point in India, but I don't think today is the day I want to be buying India.
India versus China, where would you be betting?
China, very clearly.
Sunil, thank you so much for your insights today. Sunil Garg, Lighthouse, Canton. Well, up next, Chinese robotics investors getting a big kick from this video of a humanoid android showing off some smooth kung fu moves. Goldman Sachs Jacqueline will be joining us next with what this means for China's AI and robotics sectors. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. President Trump's weakening support for Ukraine is casting doubt on a long-held policy of strategic ambiguity toward Taiwan. Our tech reporter Annabelle Drulis joins us from Taipei. And Belle, more than anything, you'd imagine that Taiwan wants to deepen ties across security, across technology.
That's exactly it has. I think if there was any sort of read-through from the conversation, that exclusive interview we had with Taiwan's Vice Premier Chung yesterday, is that Taiwan is really focused on proving its need and its value that it provides to the US, in the sense that these companies or Taiwan and the US really rely on each other for advanced semiconductor technology. Vice Premier Chung as well, she's also overseeing a drones program and build out for the island. And this is, again, another area that she's hoping to deepen that cooperation between the island and Washington on this focus. Of course, the question for drones in the country, that was a key talking point of our conversation as well, or on the island, is really about how they're going to be used and how much they can help the island also carry out asymmetric warfare if there is ever a military blockade or any sort of military invasion from Beijing. But take a listen to our conversation.
The US has always been Taiwan's most important partner in terms of regional security and in trade. We are attentive to the policies of the new US administration, and different local agencies have been studying new areas for cooperation between us. The more important thing is identifying a strategic direction for the US and Taiwan in maintaining a mutually beneficial working relationship, so we can build a democratic supply chain that strengthens the US's leadership in the global high-tech industry, while also helping Taiwan maintain its competitiveness in making contributions to high-tech development.
And what is your assessment of the way that President Trump has changed his position very radically from the Biden administration on Ukraine?
Taiwan has been monitoring the development of the war in Ukraine and related updates from Europe. We want to do our part for the Indo-Pacific region. Enhancing military capabilities is the basis for peace. We want the Taiwanese people to recognize this. Therefore, we are not only committed to building up our defense capabilities, we are also strengthening our economic resilience. This way, we can continue to take on important roles and increase our contributions to the world. The President had set the 4 pillars for peace. They represent objectives like enhancing Taiwan's defense capability, enhancing economic safety and resilience, continuing cooperation with like-minded countries, and lastly, supporting orderly exchanges between Taiwan and China.
How does Taiwan prepare, though, for other eventualities? Because there's the tariff risk that is still very present, not yet fully clarified, but there's the chance that we see 25% tariffs on Taiwan semiconductors. How is the island preparing for that?
我们都密切的在关注美国新政府相关的
We are tracking new policies from the Trump administration closely. We want to show that the future of the Taiwan-US cooperation is focused on cutting-edge technology. This is mutually beneficial and it should be a shared goal. And we're willing to expand our investments in the US with the aim to amplify our innovations in technology, including AI, chips and drones, and even R&D in future technologies. We want to stay leaders in the high-tech industry amongst democratic countries. This strategy is critical for both of us. We will also make efforts to balance trade and our increased investments in the US.
Do you think that the US is still a reliable security partner to Taiwan?
我们认为台美是
We are important partners on regional security, trade and economic collaboration. We hope to deepen ties with the US, and we believe it will be done on the basis of the Taiwan Relations Act and 6 assurances. Since Trump became president, he's emphasized the importance of keeping the cross-strait peaceful and doesn't want to see a unilateral change of status quo by force, and most democratic countries share this same view.
So the Vice Premier wouldn't exactly be drawn on that specific question. Does Taiwan still see the US as a reliable security partner? Yes, they're trying to beef up the cooperation, looking for ways that they can appease Washington as well in the Trump administration. But at the same time, there's a clear read across to their need as well for Taiwan to build out their drone technologies here and try and increase their level of self-sufficiency. And the Vice Premier, the one overseeing that drone program, not just for aerial drones, but also surface vessels and ones that travel under the sea as well.
Well, great conversation there. Bloomberg Tech reporter Annabelle Jewell is in Taipei. And of course, Taiwan not the only one wondering about the relations with the US, the likes of Canada, Mexico also wondering if those relations remain intact. For the moment, let's do a check on how Hong Kong benchmarks are doing at this point in time. Of course, we have the MXAP lower at this point in time. And in terms of the benchmarks in Hong Kong, we have that poised to snap a 6-week winning streak rather. Currently, the Hang Seng down about 2.5%. The HS Tech also slumping, currently down about 4%. Remember, though, we've seen a massive rally for the Hang Seng and the HS Tech in particular, driven pretty much by that rally on the back of DeepSeek. Now, speaking of technology, Chinese robotic stocks jumped this week after startup Unitree posted this video of its upgraded G1 robot showing off some swirling kung fu moves. The company says it's still upgrading its algorithms, and the robot can learn any action at will. Shares of Wuxi Boton in particular surging 50% this week after holding talks with Unitree on using their robot technology. Joining us now is Jacqueline Du, head of China Industrial Technology Research at Goldman Sachs. Jacqueline, good to have you with us. Talk to us about, the AI development, robotics development, humanoid robot development in China, especially in relation to the US.
Haslinda, thank you for having me. First of all, I have to say that for Goldman Sachs Global Investment Research, we have been closely monitoring the development of human robot early since 2022. And I want to say that we are very positive in terms of future outlook. And I think in the longer run, human robot development could be potentially very significant. If you think about potentially it may be the best embodiment of artificial intelligence technology. And into the next decade, we are expecting a $38 billion US market size. And in the blue sky scenario, we are looking into $205 billion US. So basically, if a human robot can potentially become an industry as big as electric vehicles or smartphones, that's driving the swing from our base case to blue sky scenario. And that's likely to bring new growth opportunities globally and also including China. And especially in China, we have the manufacturing capability and also the hardware and software know-how. And I think that's likely to be an excellent playground for global investors to look for very big investment opportunities into the coming decades.
We've been talking about the massive opportunities in humanoid robot. It is a race. It is especially a race between the US and China. Where are we with that? I mean, is the US leading in a huge way?
I would say if you consider US and also China, I think the two countries, first of all, they are driving the development of artificial intelligence technology development. And the two countries, I see them highly complementary to each other. Relatively speaking, US, they're pretty strong in terms of the AI front. If you think about the large language models, they're quite developed. Where in China, this is the world's factory. We have the hardware manufacturing capability. We have a big group of supply chain companies can be potentially the enablers of human robot. So I would say the two countries are very complementary to each other.
It is about real world cases. It is about how it can be commercialized. Where are we in that process? Is there anything that's viable currently?
Right. Technology viability, I think that's the biggest question. And where when we consider 2025, I would say when we look at globally, the leading robot players in this field, is still, the shipment outlook is probably like few thousand units for each of those leading players. And it's still primarily for R&D purpose and for training purpose and to further refine the human robot product. And it's still unclear yet whether this technology inflection point has already reached. That's still a question mark. Where in our recent report, I want to highlight that last week we published this latest report named the Supply Chain Dynamism. We defined the inflection point in terms of technology. We think that we need stronger evidence to see whether the robot can really doing useful tasks autonomously, efficiently, and with high robustness. And at the same time, they need to have quick reasoning to catch the pace of production line. It's only when we see the product is ready, then we can get more comfortable in terms of the future outlook. Where if you consider the stock market year to date has already rallied 50 plus for several of the stocks I cover, I would say the public expectation and the stock market expectation probably is a little bit faster as compared to the real development progress. So we need to see the technology pace catching up to drive sustainable share price performance going forward.
Jacqueline, you talk about how we have yet to ascertain what the robots can do. Well, we know that it can certainly do kung fu moves, as we've been showing to our viewers. I mean, how much progress does that signify, one, in terms of robotics, and how much progress does that signify in terms of China's own Gen AI capabilities?
Yeah. Well, let me give you a story. 15 months ago, when I visited those Chinese robot companies, I visit their robot labs. It's still hanging there. Basically, it cannot walk. It cannot do those fancy dancing movement. But this year, just this week on Wednesday, I visited them again. Now they can do the performance pretty robust. So you can tell the development progress is pretty fast, actually, even though it's not quite there yet. Where last year in January 2024, we had a report with the name AI Accelerant. That's how we think about the role, how artificial intelligence is important to the human robot industry development, and why the speed is so fast. We think AI, that's the most important driver. And if you compare a human robot versus the traditional industrial robot, which is rule-based, which is pre-programmed, but human robot is supposed to be a more generalized product. And the future goal for those leading robot players is to make it a general-purpose robot. So being autonomous and doing multiple tasks with a high generalization capability, that's enabled by artificial intelligence.
So it's moving at an accelerated pace. Progress has been pretty rapid. What still stands in the way of commercialization?
Well, for us, we are expecting 38 billion U.S. market size by 2035. And the rationale is we think initially it's still likely to be applied in, for example, industrial application scenarios, which is more, if you think about factory, is more structured environment, is roughly simpler for the robot to handle certain tasks. And when we take a reference to industrial product in history, for example, if you think about the upper body of the human robot, that's basically collaborative robot, right? But considering the pace of AI development, which is new, and we think the pace is likely slightly faster than that. But 2030 beyond, we think consumer application, that's the bigger market opportunity. And I think it's still some time away for those products to be really ready. But that's definitely the longer term opportunity.
How might the chip war between the U.S. and China impact development, especially in China's own robotic market?
If you consider the chips goes into the robot, we need CPU plus GPU, and NVIDIA is an important enabler of the robotics technology as well. Where between U.S. and China, when investors consider the investment opportunity in the space, geopolitical risk is definitely a factor to consider. Where for investors to think about which is the stock to play, I would say we would highlight that it's better to avoid some data critical areas. For example, sensors. It looks to me it's rather difficult for Chinese suppliers to potentially be the suppliers of the sensor component to the global brands. That's one thing. But at the same time, you can imagine in China, given we also have the AI capability, we have the manufacturing supply chain. So that also implies China may have our own robot leaders. So that's how I look at the tariff question.
So in a way, sometime down the road, you do see China becoming a supplier of robotic components. Is that a fair assumption?
At this stage, I would say the robotics component, that's the best investment opportunity for global investors, as it's more rational for those component companies if they already have the existing product with the traditional application, where human robot is just adding a new applications. Then it's relatively more, that's the investment area with a better risk reward for investor to look at it, because after what, anyway, human robot is a new industry, it's still at a very early stage. So component opportunity, I think that's where investors should go to at the stage.
We talk about the human robots. Of course, sometimes you tend to think at some stage they may have a mind of their own. We saw some visuals of a robot attacking a crowd at a festival in China. How are you assessing the risks of these human robots?
Interesting question. Put into another way, we talk about the longer term opportunity is consumer application, right? And if you think about the human robot product, I think there's still several bottlenecks that we need to solve the problems. For example, safety, that's a big problem, right? If you look at those robot products, it's 60, 70 kg, is pretty heavy. So robustness, safety issue has to be solved. Then into the future, 2030 and even 2035 beyond, there's an opportunity for us to see human robot really working around us.
One final question, Jacqueline, before we let you go. Robots at home, you know, like how far away are we from having a robot with the family?
I think for human robot, the potential demand is huge. The more important thing is whether technology is viable, right? And in terms of potential demand on the consumer application front, you can imagine, for example, household tasks, elderly care, and that's the potential area with demand. That's definitely there. It's more important about whether technology can really unlock that very significant demand potential. So that's the most important thing. And 10 years time horizon, we're looking into $38 billion US market size. And if consumer application, the technology is progressing faster than our expectation, that will unlock a $205 billion US market size. So that's the difference, and that's the opportunity.
Prospects are exciting and scary all at the same time. People are asking, is a Terminator coming? Jacqueline, thank you so much for your time. Jacqueline Du, Head of China Industrial Technology Research at Goldman Sachs. Coming up, India examining its existing tariff regime in a bid to evade President Trump's reciprocal levies. We have details of the plan next. Keep it here with us. This is Bloomberg. Well, India's been trading for about 5 minutes now. It is under pressure. Like the rest of the region, the Sensex extending its loss to about 1% right now. Of course, it's been about the weakness in the Indian rupee, weakness in the Nifty index, both feeding into each other. And some say perhaps that GDP data, if it surprises on the upside, could just be the catalyst that we need for India to reverse its negative course. Currently, the Indian rupee 83.37, down 0.2% versus the USD. Now, Indian officials are said to be looking at ways to lower tariffs on a broad range of imports, all to avoid President Trump's threats of reciprocal levies. This would go far beyond tariff reductions announced by Prime Minister Modi's administration in recent weeks. Let's get the details with Bloomberg South Asia Economy Editor Ruchi Bhatia. Ruchi, what do we know? What's being considered here?
What we do know, Haslinda, is the fact that Indian officials are exploring ways to reduce tariffs on a whole host of products. Now, what we do understand is that there are preliminary talks within the government on reducing import taxes for products that are coming in from US, which include chemicals, critical pharmaceuticals, automobiles, in fact, medical devices, and many more. This is going to be pretty important and is going to go much beyond the kind of reduction of duties that we saw recently with the government lowering taxes on bourbon, whiskey, etc. Having said that, remember the commitment between India and US is to go ahead and sign a bilateral trade agreement by the fall, which exactly means that India is going to use this tactic to shield the country from any sort of reciprocal taxes that President Donald Trump looks to impose. And besides that, remember the commitment is also to go ahead and increase the trade between the two countries, especially get products including LNG as well as defense equipment as well. So going forward, one really has to see in terms of what more can India really look to get from the US. There are talks about increasing trade of industrial goods, of agricultural commodities as well as automobiles as well, though agricultural commodities, remember, is a bit of a politically sensitive area, but how the talks will shape up between the two countries is something that is very interesting to watch. And as I said, there is already a commitment to go ahead and sign the trade deal by fall. So a lot of this will actually flow into those trade talks.
Yeah, the concern is that the tariffs will weigh on India's weakening economy. We have GDP for the fourth quarter coming out today, an improvement expected, but certainly not enough to reverse the course.
Oh, absolutely. The October to December GDP today is expected to come in at 6.2%. This is going to be higher than the reading that we saw which was a 7-quarter low of 5.4% in the 3 months to September. But having said that, it's still going to be lower than the central bank's own estimate. Going forward, there are going to be significant risks given the fact that we are looking at a whole host of global trade disruptions, reciprocal tariffs, and that could shave some bit of India's growth. But this time around, for the last quarter, we do know that government spending had picked up quite a lot. Rural consumption was good. And we also had the festive season that showed some bit of recovery as far as private consumption is concerned. But for for the next few months, what we need to see is how the net exports do, because as we spoke about global trade disruptions that are going to weigh pretty heavily on India. We have already seen the Indian government taking a whole host of steps, including the tax cuts that were announced in the budgets, and also the central bank going ahead with interest rate cuts as well. So those are some of the things that will flow in as well.
Bloomberg South Asia Economy Editor Ruchi Bhatia, thank you so much for that. Yet another benchmark that is slumping 20% from its high. This time, the Indonesian stock benchmark down 20% from that high we saw in September. Earlier, of course, we saw the SET slumping 20%. Shows the pressure that emerging markets are feeling at this point in time. That is it for Inside. Horizons Middle East and Africa is next. Do keep it here with us. This is Bloomberg.